The 2023 stock market predictions are out from Wall Street, and today we're going to break down if you should even pay attention to these.
No.
Video's done. Thanks for watching.
We appreciate it.
Hope it was good.
See you next week.
These predictions come out every single year, and there's some merit to them. These are some smart people. These are MBAs. Yeah. These are PhDs. Yeah. And they're doing some pretty in-depth analytics on what might happen in the market, right?
No, I mean, they're very smart. There's a lot of really good insights. If you read these reports, they talk about the market, they talk about the economy, they talk about the risks that are out there, but they always include an S&P 500 target return for the year. Yeah. What they think the S&P is going to close at for the end of next year. And I don't know if it's infamously, at least it's infamously here for what we talk about all the time, but they are always wrong.
It's pretty bad.
Always wrong.
It's actually really bad.
So before we jump into that, let's look at their 2023 market predictions for the S&P 500.
So what do they think 2023 is going to do?
So we put together a chart in terms of what they think that they're going to return.
Yep.
And so at the bottom of the list is Barclays. So they're predicting a negative 4.6% return.
Yeah. And there's only a couple of firms that are predicting negative returns for next year.
Right. So maybe they're saying, look, it was a pretty bad year for 2022. So we're just going to say, hey, you know what? Maybe there's some upside. Okay. Things are going to get better. Fed's going to pivot something, right?
Yeah.
But on the most aggressive end, we have a firm called Leuthold Group, which I'm not really too familiar with.
I don't know them. No.
They're based out of Minneapolis. I Googled them. They kind of, differentiate themselves in saying we are not on Wall Street, so therefore we are unbiased.
Okay. Interesting.
That doesn't make them right, though.
Okay. No, sadly not. What are they predicting?
They're predicting a 30% return next year.
It's a bold strategy, Cotton. Okay.
It's a bold strategy, Cotton.
Wow. That's okay. Great. And then we see a mix of a bunch of people in the middle, right? Normal bell curve of some people think it's high, some people think it's low.
JP Morgan's right there in the middle of the group, Credit Suisse, RBC, B of A, Goldman Sachs. So it's all kind of right there in the middle.
I think for context, it helps people to know that if you look over basically 100 years, the S&P 500 has averaged just over 10%, 10.3% pretty much when you include reinvesting dividends. But what's really interesting is if you look at, we're talking about averages, and the average almost never happens. The market very rarely returns a 10%. And if you look at this deviation, if you take 10% as the average, let me take 2% away and add 2%. So between 8 and 12, how many times does the market actually return that?
I know the answer, but you want me to give it away?
Yeah, give it away.
10%.
Yeah, basically 10% less. So it's so rare that actually happens. Yet what's really fascinating is when you ask people, hey, what do you think the stock market's going to do? They throw that number out.
10%.
They're like, 8%, 9%.
Yeah, the market. I mean, if it's going to be averaging 10%, shouldn't I just say it's going to be up 10%?
Yeah. And that's a very low likelihood of happening. So
yeah, I mean, it's going to be like this year, it's down 20-ish%, depending on where we close on the 31st. For 2022. But if you look at like 2019, the market was up like 30%.
Yeah.
I mean, you have these huge deviations on both ends. And so, but of course, it's a big distribution on both ends, but in the middle, it's going to be about 10.3%.
Yeah.
So that's 2023.
So that's what these firms predicted, these banks, brokerages, kind of Wall Street, for lack of a better word, predicts. So why should we not pay attention to them? They're sharp, right?
Because they're always wrong. That's why.
That's a good reason. Fair enough. All right. Fair enough.
But I mean, of course, we're going to look back a year from now and see how they did.
Yeah.
And so, we'll see.
And somebody might be right, but it is impossible to separate. Was it luck or was it skill? You don't know. Somebody might hit this on the number and it's impossible to know. Did they have some sort of ability to extrapolate information from the market and make a solid prediction? Or did they just guess a number and they got right?
Yeah. And if they are right, it's probably once in a lifetime thing, once in their 30-year career, and they're just going to hang their hat on.
You still see analysts all the time. This person predicted 2008 and they've been wrong for 15 years since then. And they were wrong for 15 before that.
Yeah. And also understand that these Wall Street analysts, I mean, it's a great way of generating revenue to their firm by making these outlandish claims as well.
Yes.
That's whenever you see Bitcoin $500,000 pop up on CNBC, it's going to generate clicks. It's going to grab eyeballs. And
people are drawn to confidence.
It's a marketing strategy.
Whether it's confidence to the upside or confidence to the downside, investors and people, we're all drawn to this person speaking very confidently about their point of view. Whether it's optimistic or pessimistic, I can get on board with that.
Maybe we should do that with our show. Get more subscribers for our YouTube channel.
Just make some bold claims.
Yeah, I mean, maybe we should say, our S&P 500 is going to close at 10,000 next year.
Ooh, wow. Okay, I like that. That'd be a good one.
I'm saying that very confidently. We can do that.
Okay, so what happened in 2022? How did these firms do? Anybody even close to getting it right?
No.
Okay.
No.
Stuff.
So we put together this chart. So I went back and I said, all right, well, let's look at all the different Wall Street firms and what their S&P 500 target was for the end of 2022. Now, we only have a few more days as we're recording this.
Yeah.
So things can change, but I seriously doubt the S&P is going to rally 20+% in just a few days.
Yeah, I'm with you there.
So I think it's safe to say that this market, for the year is pretty much done. And so as of the 16th, whenever I calculated all of these, here is the distribution of misses. So actually, let's go into the implied return. So the implied returns, Morgan Stanley and Bank of America were the only two firms that actually forecasted a negative year for 2022. B of A forecasted a 3% decline.
Okay.
And Morgan Stanley forecasted an 8% decline. So they were sort of the outlier, Morgan Stanley.
Yeah.
Other firms were somewhere between 7 to 12%-ish range.
So they basically just picked the average.
Somewhere between 10%.
Let's throw some darts at this board.
No one said 10. I think no one's dumb enough to say exactly 10%, but they did 9. They did 7. They did 11.
They just surrounded it. Perfect.
They just kind of like hovered right around because it's a safe pick, right? You're not putting your career on the line. It's just a very safe pick.
Imagine like 200 PhDs and MBAs from Wells Fargo all getting together and doing all this analysis and then being like, well, we can't pick 10%. Let's just bump it down to 8. Should we present 8 to our firm? They're like, yeah, let's go with 8, guys.
Yeah, we're bearish. So we're not going to pick 10. We'll take 200 basis points off of that.
And they come in with this slide deck of like, here's what it's going to be.
And here's our 15 pages of research as to how we came up with this number.
So these are way off. This average of these 11 firms was 23% off target.
Yes.
That's wild to think how far off they are right now.
And the best one was Morgan Stanley. Remember, they had that negative 8% implied return.
So they're 12% off target. And that was the best the Wall Street
firms. The best one.
And this goes to show you, it's really hard. It's not that they're in particularly bad at doing this. It's that it's just so fundamentally hard to predict the future. Nobody knows what the stock market might do, the economy, inflation. And it's really interesting. We read that Jason Zweig article in Wall Street Journal, which shows how people change their perception of what they thought they knew over time, right?
Right. Yeah. It's that hindsight bias.
Yeah. People think what they did was they ran that. They do an interview at the end of each year, which is they get their readers and subscribers to give
if you haven't read this article, read this article.
Their estimate.
Yeah,
it's called like Mirror, Mirror on the Wall, Who Predicted Stock Losses, something like that. It's from a couple weeks ago. It's a great title. And basically what they did was they interviewed people last year and said, hey, give us your stock market predictions. And then really interesting, they went back and asked them now at the end of this year, and they didn't ask for 2023. They just said, hey, do you recall what you predicted for 2022? So they want to see how people remember their predictions. And it was fascinating to watch how their predictions changed. On average, when they interviewed all these readers, the average estimate was a 6% return to the upside positive. And then when they went back, that average reader says that they implied a negative return of 1%. Yeah. And some people even that they interviewed,
7-point swing,
huge swing. Some people had predicted a 33% return for the S&P 500. And now looking back, they said, oh, I think I predicted like 1% down or 2% down. And they did this across the board for assets. They said, what do you think Bitcoin's going to be priced?
Yeah.
53,000 was the average per coin. It's just under 17.
Yeah.
They asked, what do you think the 10-year treasury bill is going to be? And same thing. The average reader said, oh, it's going to do nothing. It'll be maybe 1% yield. And now going back, they asked them and they all said, oh yeah, I predicted it would be about 3% interest, 4%. And they said, no, you didn't. Not even close.
Yeah. And you have to understand, like, what was the mindset of investors at the end of 2021 at that time? And I think that's important because keep in mind that it was a huge year. 2021 was an outstanding year for all investors. Yeah. I mean, Bitcoin was going through the roof.
Yep.
Meme stocks were the rage. Everyone was pumping out NFTs. Tech stocks, high flying stocks were still flying really high.
It's unbelievable.
And yet at this point in time, like, inflation was starting to creep higher. I think inflation closed up at 6.8% at the end of 2021. And the Fed was still trying to push the narrative that this is only a transitory inflationary
we're not
period.
concerned about this.
And so they were saying at that time, this is what they were signaling to the market, saying, you know what, like we're still doing this asset purchase program. So keeping interest rates artificially low, we're going to wind that down in March of 2022. And we're anticipating having to raise interest rates 3 times in 2022. And they began with only a 25 basis point interest rate hike in April. Was it April? I think it was April or May, one of the two, whatever the first meeting was after that March wind down. And so that's where we were in December of 2021. Yeah. So it doesn't really surprise me that these investors are saying, oh no, yeah, the market's going to go up 30%.
Yeah, absolutely.
Because the market was on a tear in 2021. And so it should just continue because humans like to think very linearly whenever we project things out.
Yeah. And I think that was so great about this article. They share that this hindsight bias of what you know now changes what you perceive you knew then. And everybody thinks they predicted 2008 or the dot-com bubble and the housing crisis. And they predicted what would happen in 2020 with COVID. And because we've got this new information and we can't quite work that out in our head of what we knew in the past. So we all thought we knew and I should have sold or I should have bought. Yeah. But this new information has changed how we perceive what we knew then.
Yes.
And the same exact thing happens with Wall Street. I mean, everybody's susceptible to it.
Well, I mean, so these firms, there's a lot of money to be made in selling research, obviously, and selling predictions. I mean, basically, these analysts are trying to predict the future, and then they package it as a research report, and then they sell it off to the buy side. So
and you have a past in this, right?
Yeah, I worked so when I was getting my MBA at UCLA, I did an internship at Wedbush, which is an investment bank in LA. And I work at the equity research department. So equity research are the firms that do the buy, hold, or sell recommendations on a particular stock. And I think the big eye-opening moment for me was whenever I was talking to one of the analysts, and he was one of the big star analysts. I mean, these individuals make millions of dollars a year. And he's been working there, I think, for like 12, 15 years at that time. And he told me, he said, over his entire career, he's been right about 50% of the time, and he's been wrong about 50% of the time.
Perfect.
And he's like, you know what? Just buy the market. And I'm like, this guy, this is his job. His job is to sell this research.
And this was early in your career, right?
Yes. And the more, that was one of the key pivotal moments for me to start my own firm and invest the way that we do, is not to try to buy individual stocks because it's obviously doesn't work. But it really got me started to like think down this thought process of forecasting and trying to pick winners from losers. Yeah. And I think it plays well into this theme. What we're talking about today is you can sit there and you can try to forecast the outcome of all of these different risks that you know are going to be present over the next 12 months. So like risks right now are going to be inflation. It's going to be interest rate risk. It's going to be Russia invading Ukraine. It's going to be grain prices. It's going to be oil. It's going to be all these different things. You know, company profitability. You can forecast all those things. And not only do you have to be right on getting that correct, but you also have to account for the things that you cannot account for, which is impossible. Yeah. And these are the black swans that you mentioned earlier, which are going to be like the events that are so far left tail events, right? These are your 4 or 5 sigma. So if you think back to your stats class, so these are like very, very low probability type events that you cannot account for, but they do crop up over time.
And when they do, they have a massive economic implication. Yes. Low probability, but just high impact event.
So COVID is the most recent example of this. So like you said, that hindsight bias, people say, oh, well, we should have been able to predict COVID. It's like, no. You know,
should have known lockdowns were happening and that would impact this. And Amazon stock would do this. And
like nobody in 2019 was saying COVID is going to be a risk in 2020. Nobody. Yeah. Maybe that one doctor, that 1 out of 7 or 8 billion people on this planet was saying is something we should be paying attention to. Yeah.
And even if you're right on that, nobody knows how the market will react to that as well. There are so many layers. I had some friends that had invested in some of these tech stocks that I would laugh at and think this is ridiculous. Then COVID happens, lockdowns happen, and these stocks just go to the moon. Yeah. And they feel like, I'm really smart. I knew what I was doing. And I think, no, that you did not have a good investment process, investment philosophy. This was just a black swan event. And of course, it's completely reversed course now this year. And they've done a round trip to negative. But the point is
money printing and supply chain issues.
The point is you can't predict this stuff. And it happens both to the positive side for people.
You're going to drive yourself
and the negative
nuts
side.
If you try. Yes.
So what should somebody do instead?
Stick to your investment philosophy. assuming that you have a really good investment philosophy. If you have a really well-defined investment philosophy, ignore the noise, ignore the investment volatility, and just stick with your plan. You're going to outperform with that versus you trying to make changes ahead of what you think is going to happen within a year or so.
Yeah, I'm the same way. I like seeing this stuff. I find the research interesting. I'm not a CNBC watcher. I don't read these reports that in depth. I take these, I look at them, and I pay zero attention to, is this going to change my philosophy or my personal
just stay
belief?
Invested.
Doesn't matter to me. So
no, yeah. I mean, you're going to spend your time on the things that are important, right?
Yeah.
If it's going to be a financial impact or a financial decision, spend the time on trying to fine tune that type of stuff.
Yeah, it's something you can potentially control also.
Yeah, you can't control the Fed. You can't control the interest rates. So
yeah.
So that's it, right?
That's
what we have
it
for today.
That's all. Thanks so much for watching. Let us know if you have any questions or leave a comment.
All right, we'll see you next time.
Thanks.
Bye.